Hello and welcome to the Fisher Connect webinar. My name is Siji Alexander and I am a Client Services Group Manager here at Fisher Investments. I am joined today by Vice President Naj Srinivas.
Thanks, Seji. So let me start first by just talking about or recapping our forecast for 2017. When 2017 started, we said that it would be a great year for global equities as animal spirits finally arrived. And animal spirits really refers to a famous quote by John Maynard Keynes, the famed economist. He was really just talking about investor confidence. And he said that, animal spirits, when investors start to get much more optimistic and confident about the market, really that can be the impetus for stocks to start to take off. And so we said that as 2017 began, you probably started to see investor sentiment start to warm up and start to move more into optimism, which should be a good thing overall for stocks. And that's exactly what we got last year. We got a pretty robust return year for stocks. We said the global economic expansion should continue, and that it did. 2017, you actually had all 45 largest economies in the world actually continue to grow, with about 30 of those 45 accelerating in growth. So the global economic expansion certainly did continue. That's not to say there weren't areas of weakness out there in the world. There always are, but overall the areas of strength pull those areas of weakness along. We said that 2017 would also be a year where non-U.S. stocks really took leadership over U.S. stocks. If you think about most of this bull market, which started back in 2009, most of this bull market has really been led by U.S. stocks. But in modern market history, you really haven't seen U.S. stocks lead non-U.S. stocks for 5 consecutive years, and 2017 would have been that 5th consecutive year. So our view was that non-U.S. stocks really take the lead for a variety of different reasons, and that's exactly what we saw last year. They squeezed ahead of U.S. stocks just by a little bit, but we think that trend is likely to continue into 2018. And then last but not least, this is probably our most contrarian forecast last year, but we said that long yields would drop on falling inflation expectations. Most people thought about, well, the Fed is hiking interest rates. Doesn't that mean long interest rates have to go up as well? Well, in our view, when we look at the long history of Fed rate hikes and yield changes on the long end of the yield curve, what we generally find is that the long end, long yields tied to things like, say, 10-year treasuries, 30-year maturity, fixed income debt, most of the time they really move on falling inflation expectations. So when inflation expectations are going up, you see those yields start to rise as creditors demand more for their money and vice versa. Overall, that worked out well for us last year. You saw long yields, as measured by the 10-year benchmark U.S. Treasury, remain fairly flat. So let's switch gears here and talk a little bit about our forecast for 2018. I mentioned this a moment ago, but we still expect an outstanding year for global stocks, despite the volatility that we've seen so far this year. Stock market returns, again, are very, very lumpy, and all it takes is really for investors to refocus on the fundamentals out there in the world, which I'll talk about, for stock market returns to re-accelerate. Especially so in the final third of bull markets, which we believe we're in right now. This is the bull market's 10th year, if you believe it started in March 2009. And we certainly don't think we're in the first half of this bull market. We think we're in the last half, more specifically, really in the final third. So our expectation is that this bull market should resume before too long. Strong corporate earnings and revenues continue. If you take a look at Q1 S&P 500 earnings, for example, they were up about 24%. Revenues were up about 9%. So that's still pretty robust fundamental economic growth that's largely being underappreciated relative to all of these big, seemingly scary headline news stories about tariffs and trade wars and all of that. So these are the fundamentals that matter most. As I mentioned earlier, we're starting to see in 2017 investors start to transition much more into optimism, and so we believe that we're much more firmly planted in optimism, although I should say that the correction we've seen so far this year has really knocked a little bit of that optimism off, and that can be a pretty healthy thing actually for the bull market to continue. It stops you from climbing too far into euphoria, which is where most bull markets meet their end. Now, the other way that bull markets meet their end, which is a little bit more rare, we've only seen it twice in modern history, is that they get walloped by something big, bad, and ugly that can knock a couple percentage points off of global GDP. We don't see any of those big, bad Wallop-sized things out there in the world, at least not a high probability one out there in the world, although we're constantly on the watch out for one. On the political side of things, we think gridlock will continue not only here in the United States, but also abroad in most developed parts of the world. We'll talk a little bit about midterm elections that are coming up here before too long. And then we also believe that non-U.S. leadership has just begun. We think that non-U.S. stocks are likely to continue leading throughout the remainder of this bull market. And last but not least, as this year began, we said that long yields likely remain benign as rate hikes continue to kill inflation expectations. We've actually seen long yields rise a little bit so far this year, and that's actually hurt fixed income overall, but our view is that rates continue to remain benign. You don't see big, huge rate moves to the upside. And even if you do see some sizable rate moves, that's not necessarily a bad thing for global stocks overall. This is a quote coined by Sir John Templeton, famed investor. He said that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And the reason I wanted to share this slide with you today is, as I mentioned a little bit earlier, we really think that in the last couple of years we've moved from this area where we were really stuck in skepticism, and we've moved much more into optimism today. If you think about this bull market generally, this has been one of the most unloved bull markets in history, really. You just haven't had the sort of enthusiasm about stocks that you have had in past bull markets. And that's actually one of the reasons why this bull market has run so long, is that investors just haven't really got on the train yet. In fact, if you just look at things like fund flows, you just really started to see investors starting to push money into equities, equity mutual funds and ETFs at last year or so. Before that, they were continuing to pull money out of equities on a net basis overall. So that's a sign to us that we're starting to march toward optimism. We're probably still pretty far away from euphoria. If you think about euphoria, it being, say, like 2000 or 1999, the dot-com bubble, where people were talking about technology and media and telecom stocks. They called it the new economy, and it was about clicks and not earnings and revenues. We're pretty far away from there today. Another sign that you can just tell that we're pretty far away from euphoria is that there's just rampant fears out there in the world. People are worried about interest rate hikes. They're worried about price-to-earnings ratios being higher than their long-term average. They're worried about a trade war. That there are those widely discussed fears out there in the world is a sign we're not really at euphoria yet. In euphoria, most of those things are underappreciated or just ignored altogether. Now, here's another slide I want to share with you, really to demonstrate why we think that 2018 could be actually a pretty great year. Now, when people look at 2017, they think that was a pretty great year for stocks as well, up a little over 20% last year. But what I'm showing you here is that more often than not, that's actually the case. And it's been some time since we've gotten a great year like 2017. And especially as we enter the last third of this bull market, our expectation is that you should actually get more of those extreme returns. So the simple way to read this chart, this histogram, is on the x-axis, you've got the frequency of occurrence. On the y-axis, you've got the annual return range. And we've plotted calendar year returns for the S&P 500 going back to 1925, where they've landed into one of these different buckets. So down at the bottom, the red bar, you've got those big bad bear market years. In the middle, say the 0 to 10%, you've got what most people expect the long-term returns for stocks to be, around 10%. But you'll notice that up at the very top, where returns are greater than 20%, well, stocks are up actually a lot, almost 40% of the time. And specifically, really, when you look at the final third of bull markets, historically speaking, you get those pretty robust returns. And 2017 was a year we got pretty robust returns. Before that, it was 2013. So we really haven't had a lot of those pretty big up years since this bull market began. And that leads us to believe that 2018 could still be a pretty good year. Now, here's another way to look at that statement that I made earlier, which is that bull markets accelerate in their final third. What I'm putting on the screen here is the average of all bull markets going back to 1932. The simple way to read this is the x-axis is the duration of the bull, so where you see the 0 on the left-hand side, the 0%, that's where the bull market began, and the 100% on the right-hand side, that's where bull markets ended. And of course, the blue line represents where bull markets are delivering their return along the way. So as bull markets begin, you generally see the right side of a V shape. You have some pretty robust returns before you get this pause that refreshes in the middle. And then the bull market accelerates out of its final third. And so we believe actually we exited a period of pause, so to speak, that really went from about 2014 to 2016-ish. 2017 was probably the first year entering into the final third. And as we sit here in 2018, we've moved a little bit up the curve, but there's still likely more bull market to go. In fact, the longest bull market in history is the 1990s bull market. That was a 10-year bull market, almost uninterrupted. Ken has on frequent occasion said that this bull market could in fact rival or even surpass that bull market should all the conditions that currently we have in place continue to play out. So, we try to only forecast 12 to 18 months out in advance, but this bull market could in fact run in maybe another 2-3 years. Now, next I want to talk a little bit about, well, if this bull market has more room to run, what are we looking for to understand where it might end? And this was a quote that Ken wrote in his USA Today column in September of last year. What he wrote is that bull markets don't die of old age or from maxing out some fantasized preset allotment of new records or all-time highs, that sort of thing. They expire when investors run out of worries and reality can't beat lofty expectations, or when some huge unforeseen negative worth trillions of dollars wallops everyone. So those last two sentences are really talking about the two ways that most bull markets meet their end. As I mentioned earlier, investors get far too euphoric relative to reality. As I mentioned earlier, stocks move on the gap between sentiment and reality, and so if people's expectations are sky high and reality settles in even a little bit lower or a lot lower in some cases, that's the recipe for stocks to fall in a pretty big way. The second part, or the second way that bull markets meet their end, a little bit more rare, is that you get that huge unforeseen wallop that can knock a couple $1 trillion off of global GDP in a fairly short period of time. Much more rare, but something we're always on the lookout for, and I'll help you scale what that means here in a moment. Now, this is what you call a scatter plot. This is a little complicated. I'm not going to spend too much time explaining this, but really what we did is we took a quantitative view of, well, is there some story there? Is there really a there behind the notion that, well, when PE ratios are high for the market, returns thereafter have to be pretty low or sluggish or down? And what this tells you here is that there's no correlation between those two statements. Really, you can have high PE ratios where they're above their long-term average and still have pretty robust stock market returns thereafter. There's just no there. Scaling is always a very powerful tool in your arsenal as you're trying to understand economics and what's going on in the world. And so what we looked at is, well, what are U.S. duties collected as a percentage of imports for consumption? So this just tells you the impact of those tariffs. Although the dollar amount is pretty big, remember that they're only tariffing 15 to 25% on the overall dollar amount. So it's much, much smaller than you think. And of course, it all depends on the fact that actually providers or importers of those goods bringing them directly in from countries that are impacted by those tariffs. In today's increasingly globalized economy and world, where for a small fee, you can actually route a lot of your products through a secondary country before it enters in the United States, the power and impact of tariffs are much, much lower today than they were in the past. So all of this is just to say that even looking at the enacted tariffs and even the proposed tariffs that we saw today, they really just don't have material power relative to the size of the U.S. economy or the Chinese economy overall. So here's another way that you can scale the impact of tariffs. So I mentioned earlier that when we're looking for the two ways that bull markets meet their end, the first is the wall, where you get that really euphoric sentiment relative to reality that settles in somewhere below that. The second way is you get some event that's big, bad, and ugly out there and that can knock a couple $1 trillion off of global GDP. Well, this helps you scale that. What does that mean, a couple percentage points of global GDP? Well, That's about $5.1 trillion if 2017 GDP, global GDP was $79 trillion. So as you start to think about these tariffs and their actual impact, you got to scale those relative to what can actually knock global GDP. $5.1 trillion is needless to say, much, much more than the impact of we've seen on these tariffs so far. Now, could a big, bad, much broader trade war between China and the United States get to the point where it has the ability to knock a couple $1 trillion off of global GDP? Absolutely, it could. That's something that we're watching out for, watching very carefully. But right now here, we don't see that being a big possibility or probability because the world is just more globally interconnected today. If anything, this is just political rhetoric, the same political rhetoric we've seen year after year, time and time again. There's just a much bigger megaphone or spotlight on it today than we've seen in the past. Now, switching gears to politics for a second, we have midterm elections coming up in November of this year. And if you think about the way we see the world, we always categorize everything that's going on in the world into kind of three buckets that we call drivers. We want to look at economic and fundamental things out there in the world. We want to look at sentiment. What are investors thinking? What's the marketplace thinking on stocks relative to reality? But then we also want to look at politics, because politics has the ability to impact a lot of what goes on in capital markets. So one of the most common things that have been coming up is, well, the midterm elections, what does that mean? Does this mean that gridlock continues? Many of you likely recall that we believe that gridlock is good. Gridlock means that the status quo is maintained and that stocks have certainty. Stocks hate one thing more than anything else, that's generally uncertainty, and legislation, especially big, broad, sweeping legislation, creates uncertainty. So the inability to get that big, broad, sweeping things done is actually pretty good. So let's talk a little bit about the midterm elections coming up and what our views are on them. What I put on the screen here, this is a lot of information. It's likely pretty small on your computer screen as well, so I'm not going to go through all of this in great detail. What I put up on the screen here is the 2018 and 2020 Senate elections. So let's focus on 2018 for a moment. 2018, what we're just trying to demonstrate to you here is that the blue lines there are Democrats up for re-election in 2018. The red lines are Republicans up for re-election in 2018. And you just have far more Democrats that are up for re-election in the Senate this year than you do Republicans. That means the Republicans have a little bit of a structural advantage in the Senate relative to the Democrats, and it would take pretty flawless campaigning from the Democrats in order to retake that chamber. So we don't view that as highly likely, just given the structural advantage that the Republicans have in the Senate. However, in the House, that's a bit of a different story. Historically speaking, in midterm elections, a president's party almost always loses power. This year, not likely to lose power in the Senate, as I mentioned a moment ago, but maybe a higher probability of the Republicans losing the House this year. Simply, again, because of the structural elements there. There's far more Republicans coming up for re-election and having open seats tied to retiring representatives relative to the Democrats. The Democrats really only have to take about 25 seats in order to retake the House. So when you think about that and you consider that, you also think about the historical trend that we've seen in the House. In 23 out of the last 26 midterm elections, dating back to when that chamber became 435 members, you've actually seen the president's party lose power in the House. And so that's a pretty powerful indicator for us, especially relative to the structural imbalance that you see in the House, to suggest that you may get actually a split Congress with the Republicans maintaining control of the Senate and the Democrats are taking control of the House. Of course, you've got a Republican in the White House, and what all that means is that you probably get much more of the traditional inter-party gridlock next year. Even if the Democrats don't manage to actually take the House and the Republicans maintain control of the House, you probably still get a lot of the intra-party gridlock that we've seen much, much more of so far in this presidential cycle. And that should put a downward pressure on the ability for politicians to get that big, broad, sweeping legislation passed between now and 2020. As you look ahead to 2020, and especially in the Senate, That structural advantage I talked about that the Republicans had in 2018, well, that flips on its head a little bit, actually. And what you get is far more Republican senators up for re-election relative to Democratic senators. And so, again, you might get more gridlock moving forward there. Now, another factor to consider, and one that bodes well for stocks looking ahead, is what we call the 87% midterm miracle. Generally speaking, as I mentioned earlier, a president's party loses power in midterm elections, and that means much, much more gridlock and the inability to get things done. Well, that's a pretty good thing for stocks. And when we look back all the way into the 1920s, what we find is that overall and on average, in the subsequent quarters following that November midterm election, stock market returns are overwhelmingly positive. Pretty robust, high single-digit returns overall, but overwhelmingly positive, up about 87% of the time. Much greater than what I would say is the long-term average, which is stocks being up about 70% of the time. So to us, this is just another sign that as you start to get much more certainty about midterm elections, you start to close in towards the end of the year, that actually could be the impetus for stocks to start to pop much more. Markets get much more certainty about what the political drivers look like here in the United States. So what I'm looking at here is non-U.S. outperformance and how long it generally lasts once non-U.S. stocks, historically speaking, start to outperform U.S. stocks, and then the margin by which they outperform. So what you see here is that on average, when non-U.S. stocks start to outperform like they did last year, they continue to outperform by about 3.2 years. On a relative basis in terms of performance, total return, they're outperforming by close to 100%, 94%, and on annual basis, about 30% on average. So the major takeaway here is that when non-U.S. outperform, it generally does for a while, and it generally does by a lot. Now, the yield curve, some of you may be familiar with it, but the yield curve, quite simply speaking, is the difference between long-term rates out there in the world and short-term rates out there in the world. And it really speaks to banks' profit margins or banks' propensity to lend. When that yield curve is high and rising and upward sloping, it's very profitable for banks. When it's flat or inverted, it's not quite so profitable for banks. And of course, banks lend. Lending is the oil in the engine of the economy out there in the world. So when we look at the United States yield curve, the green line that I put on the screen here, what you see is that the United States yield curve has actually been flattening for the last couple of years. Now, that's not automatically a bad thing. It doesn't automatically portend doom or an oncoming bear market. It is something to watch, though, as you start to look at lending. Now, looking at total bank loan growth in the United States, we've actually seen as the yield curve has flattened out, we've also seen total bank lending decelerate. That's not to say that it's turning negative. There's still positive loan growth out there in the world, but it's decelerating from where it was earlier. Now, you compare that to where the European Union, for example, United Kingdom is. Here, the orange line is the EU's yield curve. And what you see here is that it's actually been steepening for the last couple of years. Now, that also bleeds into loan growth in, say, the Eurozone. Eurozone total loan growth has actually continued to grow positively since about mid-2013. So again, this is all just to point out that we're at a little bit different stages in our business or economic cycles. The United States is a little bit farther along than the EU and the Eurozone are. You're starting to see some decelerating loan growth in the United States while you're seeing accelerating loan growth in the Eurozone. Now, another fear that we hear about a lot tied to lending out there in the world is, well, what about money supply? Isn't inflation going to start to run, especially as things like quantitative easing have wound down? The Federal Reserve is going to start clearing out assets on its balance sheet. Doesn't that mean inflation has to run away here? Well, no, not quite. Actually, what we've seen most of this bull market, in fact, and this is another reason why this bull market may have run as long as it has, we've seen most of this bull market is that money supply growth has been fairly tame, especially when you compare it to prior bull markets. And that to us tells us that when you have this kind of stable money growth, well, inflation expectations, and inflation's unlikely to really get too far out of control, and that actually puts you in a little bit of a Goldilocks environment for a bull market, where you have modest economic growth, strong corporate earnings and revenues, modest inflation as evidenced by money supply growth, all against a backdrop of investor sentiment that's not quite euphoric yet. That's really the recipe for stocks in this bull market to continue for some time. So now I actually want to move into the last part of our presentation today, which is really just preparing for volatility. As I mentioned earlier, 2017 saw historically low volatility. You didn't have more than 8 trading days where stock markets or the S&P 500 was up more than 1% or down by more than 1%. Historically speaking, that's pretty rare. And as we entered into 2018, our view is that, as is always the case, the probability or the likelihood you get much more volatility is pretty high. Corrections and bears unfold differently, requiring different investment approaches. So I'll talk a little bit about a correction, as I mentioned earlier, which is what we believe we're in right now. But then also the signs that we see as bears unfold and how you actually really want to approach those from a portfolio management standpoint. And then last but not least, a reminder that volatility is normal. And it's really your reaction or your lack of a reaction to that volatility that impacts your longer term returns. Remember I said earlier that the 2 keys to being a successful long-term investor is patience and discipline. And unfortunately, it's when you see a lot of volatility that we've seen today where people start to look around, they say, well, this isn't yielding this much or this isn't returning what I want, that people make impulsive decisions and they end up selling out low and buying high, which is, selling out of something at lows and having to buy it again at a high, which is really the opposite of what you want to do out there in the world. So patience and discipline are keys. So as I mentioned earlier, corrections are fairly common throughout most bull markets. Here I've got the last 3 bull markets on the screen, including the current bull market. You see the 1990s bull market had several fairly sizable corrections. The 2000s bull market likewise had 3 fairly sizable corrections. And then this bull market had about 5 or 6 fairly sizable corrections. The thing that you ought to take away from here is that, again, just as fast as corrections begin, they tend to retreat and the bull market resumes course. Now, what that means is that timing correction is very, very difficult. And we at Fisher Investments haven't found anyone, professional or otherwise, that's been able to successfully and repeatedly time market corrections, get out of them, but then importantly also get back into them. And that's where a lot of people end up getting whipsawed. They get out of them at the right time, but they can't get back into them before the market takes off again. And of course, don't forget, you're incurring transaction costs on both sides of the trade. And of course, there may be some tax implications for you as well, doing all of that selling. So in our view, when you don't see those fundamental factors that make you believe you're entering into a bear market, and you think that it's much more a correction, the best course of action is just to remain calm, patient, and disciplined and ride through them. Now, just as Sir John Templeton had his quote describing the market sentiment evolution in a bull market, what we're sharing with you here is the market sentiment throughout a bear market. This is something that Ken coined. We said that bear markets are born on euphoria, grow on grinding economics, mature on recession, and die on panic. So really, he's trying to describe what people are feeling like as a bear market unfolds. And actually, this is pretty powerful when you consider the rules and heuristics that Ken and the investment policy have laid out when thinking about bear markets and their anatomy. So keep this in mind here for a moment. Now, before I get into those rules, what I want to share with you is just this, bull and bear markets in perspective. People spend a lot of time worrying about bear markets and when the next bear market is going to occur. But what they miss is that just staying invested for sufficiently long periods of time is really what's most important to getting to their long-term goals and objectives and getting market-like returns over time, which is what most people actually fail to even be able to do. What I put on the screen here, the blue line is the S&P 500 price level on a logarithmic scale, which is the right way to look at long-term returns over time. And then those green areas are bull markets along the way historically, and the red itty-bitty areas are bear markets. Everyone spends so much time focused on and worrying about the red areas, which can be very, very scary in the moment, that they often sell out of things and they miss large parts of the green areas of the market. And that's what we're trying to prevent people from doing, is selling out of the wrong time when a bear market really isn't unfolding, but it's just normal stock market like volatility, and trying to get people to stay invested for sufficiently long periods of time to get market-like returns. I'll talk a little bit more about that in a moment here, but the simple fact of the matter is that most people simply just can't do that over time. Now, when people think about bear markets, what they generally think about is the big, steep drop in a bear market. They think about bear markets as them falling off a cliff. But in reality, what you generally find in a bear market is that they begin slowly. They have this rolling top feature where they gently lull investors to sleep. So they decline by about 2% per month on average for a whole bunch of months in time. And that rolling top feature is really designed to lure more investors in as they're euphoric and thinking that, well, everything is good out there in the world, there's nothing bad that's happening, but in reality there is something big, bad, and ugly out there in the world. So this is the first sign that we look for. What we're looking at here is the 1970s bear market. And you can actually apply these heuristics or rules to any bear market out there in the world, and they largely work. But these are guidelines, again, for how we're forecasting and identifying bear markets. So this is the 2% rule, the first thing that we look for if we are trying to identify a bear market. Now, the second one is the 3-month rule, and this really goes back to a columnist that Ken followed when he was first getting started writing in Forbes magazine. But the concept here was that because stocks are really only dropping by about 2% per month for the first couple of months of a bear market, well, that actually affords you some time to really make sure that you can be right. Because the cost of waiting 3 months after the perceived peak of a market is low relative to the total drop. The simple way simply put, we're trying to say here is that one of the most dangerous things that you can do in investing is actually a defensive portfolio, to take people and clients off their long-term trajectories, which may require them to get growth or returns much, much higher than, say, cash, take them out of that positioning and put them in a defensive positioning, which is going to get you cash-like market-neutral returns. So you really want to be right that you are entering into a bear market. And that's where you say, well, maybe we wait 3 months until the peak or after you perceived a peak, and then you can actually start to get defensive in your portfolios, because the largest part of the drop happens after the 3 months, as you'll see here. Here's the 1970s bear market. 3 months in to this bear market, stocks were really only down about 6%. But thereafter, after those 3 months, you actually saw stocks fall about 45%. So that's really the biggest swath of what you want to cut out. Here's another way of looking at that same data for the same bear market. This is what we call the 2/3, 1/3 rule. And simply put, all we're trying to say here is that about 2/3 of the bear market's decline come in the final third of its duration. So the first 2/3 of the duration, you only get about 1/3 the drop. It's the final third that you get 2/3 of the overall drop. That's the biggest part of the market that you really want to cut out. You really want to try to sidestep. And if we can identify a bear market correctly for you and sidestep a biggest part of this, well, then we'll get you to your long-term goals and objectives just a little bit faster. Now, the last rule is the 18-month rule. And simply put, the 18-month rule is a way for us to ensure that we're not going to miss the oncoming bull market after a bear market. Bear markets on average run about 18 months or so. And so as you're approaching that 18-month mark, maybe a little bit, maybe before, maybe a little bit after, as you're approaching that 18-month mark, you want to start to think about re-equitizing, getting more equity exposure to a bull market, a nascent bull market that's going to unfold. Because some of the strongest returns in a bull market actually happen in the initial upswing, the initial couple of months that the bull market begins. And missing out on even a handful of those days can actually impact your long-term returns over time. So it's just something to keep in mind.
Thank you so much, Naj. That's all we have time for today. Thank you for joining us for today's Fisher Connect webinar.